Yeah, I'm losing my edge.
Let's call today's segment what it is, defending short stock trades, Pete. Something that
appropriately named and appropriately timed.
Yeah, appropriately timed. Well, this morning we saw a little bit of a sell-off in stocks,
right.
And I thought, man, this is not going to really hit here this afternoon if the selling continues. But what we've seen in the afternoon is what we've seen the last couple of weeks is every sale in stocks is met with more buying. And then on the average day, we're just seeing some upside in stocks. And so this is a scenario where if you're holding a short stock position, Pete, very different than holding a long stock position and needing to defend that. Because when you're short stocks, it tends to be a slow grind against you. Whereas the long stock position that needs defense, it's usually boom, oh crap, I need to do something, right?
Yes. Yeah, it's a very different type of defense. You're right. It's a patience defense. I mean, this year's been an odd year because sometimes we've seen rallies that have in time been more aggressive and taken less time to unfold than some of the breaks. But traditionally, when we're looking at the playing the odds in terms of behavior, you're absolutely right. The upside moves are the downside move, the hedge becomes very apparent. The defense becomes very apparent very quickly.
Yep.
Here, it's a little bit more of a challenge. You're
absolutely. You see pretty much like the only down move is this early mid-March, and it's a violent one. I mean, here we're looking at SM75, the small stocks product, and it gets almost cut in half in the matter of a couple of weeks, and it makes up all of that ground. But you see here, it took months to make up all of that ground. And aside from, like you said, Pete, these one-off, like this was a big day right in here. The movement of actually like the last couple of days have been pretty decent big days, but for the most part, you get stuck in this here, the like grind higher. And that's very different to need to protect than this big move here. And honestly, what's nice about this is I think, and what we're going to see here, it's oftentimes easier to defend a short stock position because you have more time. The key thing there is patience, and you can apply these tools that we're going to get into. Whereas if you're long and you need to defend a long that's going against you, it's usually, oh man, like I needed to defend this 10 minutes ago, and it's already, it's already getting worse minute by minute. The tough things of defending a short position, Pete, is that movement and option prices usually drop in a big way amid a bullish market. You see here the bullishness we've seen in the last couple of weeks, and you and I both have some short positions that we need to defend. That's the sake of the show here today. With that, you see a downside in volatility, and that means two things, Pete. One, option prices that you could use to help defend your short trade, those prices have declined. And two, you're not getting as much back and forth, not as much movement to get in and out of those positions that you want to defend. And so you get to this problem now of, the thing we know about stocks at highs is that they can stay here for a while. And so now how do I defend against that with lower implied volatility and lower movement? And you see this, this part of the chart here in mid 2016 all the way through 2018. This isn't, bouncing off of a sell-off, Pete. This was new high. And so you can get caught up in that, and it can be pretty bad if you don't have some defensive tactics. And especially, Pete, if you're holding shorts in markets like the E-minis or micro E-minis, because, Pete, these are costly positions. I mean, if you put on a short E-mini contract, Pete, and you just have to sit with $180,000 contract, a margin that's $12,000 that you have to set on the side for weeks or even months, or like we just saw, years at a time, that's a big chunk of change.
Absolutely. And, it's funny. I haven't ballparked the math in a long time, but, I remember I've been at Tasty Trade and Smalls for almost 6 years now. And I would say 3, 4, and 5, we always looked at the bouncing notional of E-mini sitting between 115 and a rich side of it was slightly north of 130. The change in these notionals, and you've done some great segments of research about things getting expensive in terms of the notionals. I mean, we're in a whole new spot, and I think that speaks to what we're doing if we're going to trade what we call an extreme. and how we do that. And it's a different game than it was at $130,000 notional versus $180,000, and the amount of daily movement there too.
Yeah.
Materially different, as you would expect, but the ability to defend that becomes, I mean, I think it's even more important. It's always important, but the idea of structuring defense around product selection becomes critical now, and understanding what you're picking, with the misnomer E-mini to start with, but it's not your brother's E-mini, which, I mean, it's a very different contract than it was 2 or 3 years ago, which in trader-esque is not that long of amount of time.
Yeah, absolutely, Pete. And it's almost like defense starts with that product selection here, because
Agreed.
everybody, Pete, when they get to futures, they want to be a cowboy immediately. Like it's like, oh, give me the /ES, and I'm making a few $1,000s in the next couple hours, and I'm going to be a real hero. And you quickly find, even if you profit from that first trade or those first 2 or 3 trades, you're never really going to get hit. And it's fun to make $500 or $1,000 on these big markets, but the first time you get hit for $2 or $3 grand, you're done with this. Like, you swear off of it. And I went through this process as well. It's not to say that I'm smarter than anyone else, but defense starts with this product selection. And it gets to this point, Pete, where yes, I look at this $2,000 daily move in the E-mini, or even $200 in the micro E-mini, and I go, yes, that is what I want. I want to sell this product, and I want to make $2 grand. But when you combine that with what we just looked at, which is the fact that these markets hang around these highs, Pete, you're most likely going to take a day or 2 worth of losses before you start to see those profits if your short position is correct. And so defense starts right here. Can you sit with $2 grand, $4 grand, $6 grand in losses, which you'll probably have to sit through for a short position before potentially getting to profits? I can't do that. I don't know a lot of people who can do that. And so that being said, you go to the micros, but even this, you stack up like we've seen this week, Pete. Every day this week has either been this week's stocks have either been unchanged or higher. And so you stack up 3 or 4 of these days, and now you're out $1,000 before you could potentially see some downside in stocks. Whereas you go to the smalls here, these are markets that are all priced to move between $50 and $100 per day. And so even you're waiting out an up move like we're seeing right now. If I can get back to this chart, you see this up move, you're waiting this out, but you look at this axis, and even in an outlier move through all-time highs like we're seeing right now, you're only out $300 to $500 depending on where you got in here, not $6, $7, $8 grand, or $2 or $3 grand with the micro E-minis. The defense starts there, but Pete, it also it can be as simple as decreasing your size or scalping around your bias. And this is something that I think you can speak to here, which is, looking at 2018 as an example. You're short through this whole year, and the market goes from 50 or just below 50 to 55. But Pete, scalping around means that you can kind of try to pick these peaks and also to add your short positions, and then also try to pick these troughs to unload some of it. And say throughout 2018 here, Pete, you wanted to have 5 contracts on at all times. Instead of having just 5 on throughout the whole year, you maybe have 2 or 3 on the whole year, but you're trading 1 or 2 back and forth up here, right? That's scalping around it, right?
And that's the empowerment of adding multiple units. And it's not to say that if I trade 1 contract and I find a profitable strategy, if I trade 3, I'll just make 3 times as much. Not saying that at all. It's the flexibility around trade location and management, as you said, to have a core position and then work both sides of the market on that core position to either extend your defense or scale it back. And, Frankie, I'm going to ask you jump back to slide 1 really quickly, because there's something that, or 2, I apologize. Where's the one with the movement on it? Am I missing? No. Maybe it's 3. Sorry. There we go. 4. Thanks. I apologize, guys.
Thankfully, this isn't a game show, right?
I know, yeah, I just bought myself a donkey. You look at that E-mini movement of 2150, and this is the exercise oftentimes you'll hear traders go through. Well, I can take advantage of that large product and that movement. I'm just going to lower my downside, my loss expectations down to $200, $250. That's where I'm comfortable with. I mean, I'm comfortable in the world of $200, or let's say $100. Here's the challenge, though. That's the daily range. To parse that portion of 10% is impossible. So you can't take something that gives you this amount of movement and say, well, I'm only going to choose to participate in 10% of it, 5% of it, because that's my comfortable loss level. You're going to find the churn, and we've all gone through this trying to be overly myopic in what we want to manage the trade around, given what a market gives you. There's no way to do that. You can't do that successfully. So you have to go to what you highlighted is a smaller product that fits within the movement it's giving you, the traditional movement, whatever, the daily movement, how statistical movement, whatever we want to assign a name to it, that has to fit into your comfortable. Because trying to skin these other ones down is a futile exercise. So sorry, Frankie, I didn't mean to.
No, you're good. You're good.
It's an important part of, I want the upside of the $2,100, but I'm going to micromanage the downside. You just can't do it.
Yeah, absolutely. I hear you on that. It's a very, very good point. And let's close with this point, though. The last thing that you can do here, aside from correct product selection and reducing size or getting in and out of a portion of those multiple units, as long as you're using the right product, there is say, okay, I'm going to put on an option position for the next couple of weeks or next month or two, and I'm just going to reduce the size of this trade, and I'm also going to profit if the market just remains unchanged or slightly higher, slightly lower, and I can keep my short trades on. And how do you do that? You use some short options here, and since you're short the market, you're looking at short puts or put spreads, and here per small exchange contract, whether you're using SM75 or sticks, I highlighted for SPY or S&P futures, QQQ or NASDAQ futures, IWM and Russell futures. You go into these option markets, the equivalent is about a $5 to $10 wide spread in the S&P world. NASDAQ slightly different, Russell the same as the S&Ps. And that's the width of the spread that I would look for, and the credit for each of the spreads that I would look for are also down here. And so there's from A to Z kind of, how do I defend a short? Well, it starts with picking the right product. Then how flexible can I be to, either decrease the amount of exposure I have for the whole trade, or get in and out of that, scalp around that opinion. And then finally, you can add some options here with plenty of markets against your shorts and small futures.